Hey everyone, I'm Ravi Bagla from Ravishing Homes powered by Remax Realty Services. Buying a home is a huge step and likely the biggest investment you'll ever make. One of the biggest questions I get asked by aspiring homeowners is, should I go with a CMHC insured mortgage or save up a 20% down payment and avoid it altogether? In this video, we're going to break down everything you need to know about CMHC insurance in 2025. Whether you're a first-time buyer or a seasoned homeowner, this video will equip you with the knowledge to make a confident and informed decision. So, let's start with the basics. What exactly is CMHC insurance? CMHC stands for Canada Mortgage and Housing Corporation. It's a crown corporation, meaning it's owned by the Canadian government. CMHC insurance isn't there to protect you, the home buyer. It's actually there to protect the lender in case you default on your mortgage payments. Since you're putting down less than 20%, they see it as a riskier loan. CMHC insurance mitigates that risk. The great thing about CMHC insurance is that it allows buyers to enter the market sooner with a smaller down payment. Instead of the traditional 20%, you could potentially purchase a home with as little as 5% down. You'll pay a premium for this insurance, which is calculated as a percentage of your mortgage amount and added to your mortgage. While CMHC is the most well-known insurer, there are others like Sagan and Canada Guarantee that offer similar coverage. Let's talk numbers. How much down payment do you actually need for a CMHC insured mortgage? For homes up to $500,000, the minimum down payment is 5%. For homes priced between $500,000 and $1,500,000, it gets a bit trickier. You'll need 5% on the first $500,000 and then 10% on the remaining amount. Imagine you're eyeing a beautiful $900,000 home. You'd need 5% of the first $500,000, which comes out to $25,000. Then, on the remaining $400,000, you'd need 10%, which is $40,000. Add those together, and your total minimum down payment would be $65,000, or approximately 7.2% of the purchase price. Keep in mind that for homes over $1,500,000, CMHC insurance is not an option. You'll need to bring at least a 20% down payment to the table. Chapter 3. CMHC Pros and Cons. The biggest advantage of going the CMHC route is that it allows you to enter the market sooner. Saving up a 20% down payment can take years, especially with rising property values. CMHC insurance lets you get your foot in the door with a smaller down payment. Another pro is the recent update allowing for 30-year amortization periods on newly built homes, meaning lower monthly payments. However, the most significant drawback is the premium you pay for the insurance, typically ranging from 2.8% to 4% of your mortgage amount. This premium is added to your mortgage, meaning you'll pay interest on it over the life of your loan. Additionally, CMHC insured mortgages often come with stricter lending criteria. You'll need a good credit score and a manageable debt-to-income ratio to qualify. Chapter 4. Buying without CMHC. The most significant advantage here is financial savings. Since you're not paying a premium, your monthly mortgage payments will be lower, and you'll save a substantial amount of interest over the life of your loan. Another perk is increased lender flexibility. Without CMHC insurance, lenders have more leeway in setting their terms and conditions. Plus, you can purchase any property, even those exceeding the $1.5 million CMHC cap. However, the most significant hurdle is saving up that hefty 20% down payment. This requires considerable financial discipline and planning. Waiting to save that amount might mean missing out on opportunities in a rising market. Property values could appreciate faster than your savings grow. Chapter 5. What should you choose? The answer depends entirely on your unique circumstances, financial situation, and goals. If you're a first-time buyer eager to enter the market and don't have a massive down payment saved up, a CMHC insured mortgage might be the way to go. It allows you to buy sooner and start building equity. If you've been diligently saving and have a 20% down payment ready, Opting out of CMHC insurance could save you thousands of dollars in interest over the long run. For those looking to purchase a property exceeding $1.5 million or seeking greater flexibility in lending terms, going without CMHC insurance is the only option. Your dream home awaits. Both paths to homeownership have their merits. One gets you into the market faster, while the other saves you money in the long run. Ultimately, the best choice depends on your budget, timeline, and goals. Need help crunching the numbers and figuring out which path aligns best with your aspirations? Call me at 905-302-5070 or visit my website at RavishingHomes.ca. Let's chat, explore your options, and build a plan that makes your homeownership dreams a reality. Thanks for watching. See you in the next video. Thank you.